Why would one of the world's most profitable car makers deliberately refuse to sell as many cars as it could? In the automobile industry, scale is usually treated as the foundation of profit. Developing a new model costs billions. Factories are expensive to build and maintain. Safety standard software, batteries, emissions rules, and global supply chains add even more fixed costs. The conventional answer is simple: produce more vehicles, spread those costs across more units, and make each car cheaper to build. Ferrari follows a very different logic. Compared with the largest luxury car makers, Ferrari sells remarkably few vehicles. It does not try to fill every market with inventory. It does not compete for the highest sales volume. And it does not respond to strong demand by increasing production as quickly as possible. Yet the company can still grow revenue and profit even when vehicle deliveries rise only slightly, remain almost unchanged, or sometimes decline. That is the contradiction at the center of Ferrari's business. The common explanation is that Ferrari simply charges extremely high prices. Its cars are expensive, so each sale must generate a large profit. There is some truth in that. But price alone does not explain the full result. Other luxury manufacturers also sell expensive vehicles. They also offer powerful engines, advanced technology, exclusive materials, and prestigious badges. Some of them sell far more cars than Ferrari. Yet very few can match Ferrari's ability to protect profitability while keeping production deliberately limited. The real question is not why Ferrari costs so much. The real question is why customers continue to accept higher prices, wait for limited production, spend more on personalization, and compete for access to products that the company could theoretically produce in greater numbers. This matters because selling fewer cars normally creates a disadvantage. A smaller production base means research engineering factories, racing technology, and regulatory costs must be absorbed by fewer units. Under normal industry economics, that should make the business less efficient. Ferrari appears to turn that disadvantage into strength. Its financial performance suggests that the number of cars delivered is only one part of the equation. Product mix, special models, market allocation, and personalization can increase the economic value of each vehicle without requiring the company to dramatically expand production. That means Ferrari may not be optimizing for the greatest number of transactions. It may be optimizing for the greatest possible value from each transaction while protecting the conditions that make customers willing to pay more. But this creates another problem. Scarcity does not automatically produce profit. A company can restrict supply and still lose customers. It can raise prices and damage demand. It can call a product exclusive, but exclusivity means nothing if buyers do not care. So Ferrari's performance cannot be explained by scarcity alone. To understand why selling fewer cars can produce stronger economics, we need to examine how Ferrari connects limited supply, product personalization, customer demand, and brand value into a single business model. Because the most important part of Ferrari's strategy may not be how many cars it can build. It may be why the company chooses not to build more. To see why this approach works, it helps to step back from Ferrari itself and look at the economics of the automobile industry. For more than a century, the industry's dominant logic has been built around scale. Once a manufacturer spends billions developing a vehicle platform, designing new engines, building production lines, and establishing a global supplier network, every additional vehicle helps spread those fixed costs. Higher production generally lowers the average cost of each unit. That is why most major manufacturers constantly search for larger markets, broader customer segments, and higher factory utilization. Luxury manufacturers follow the same economic principle, even if their products target wealthier buyers. They introduce more sport utility vehicles, expand into new regions, share components across different brands, and increase production whenever demand supports it. Growth is usually measured by how many additional customers can be reached without damaging profitability. Ferrari deliberately rejects that objective. The company has repeatedly stated that preserving exclusivity is a fundamental strategic priority. Rather than matching production with market demand, Ferrari intentionally keeps supply below the level that the market could absorb. During its Capital Markets Day, the company described its long-term ambition as continuing to deliver growth while preserving scarcity, maintaining the balance that has defined the brand for decades. This philosophy influences almost every major decision the company makes. New models are introduced carefully rather than flooding the market with frequent replacements. Production expansion is measured rather than aggressive. Limited series models remain genuinely limited. Even geographic allocation becomes part of the strategy, ensuring that no individual market becomes oversupplied. Seen from a traditional manufacturing perspective, these choices appear inefficient. If customers are waiting, why not build more cars? If demand exceeds supply, why not increase production until that gap disappears? Most companies would. Ferrari intentionally does not. That decision becomes even more interesting when looking at how the company generates revenue. Although automobiles remain the core business, Ferrari is not dependent on the vehicle itself as the only source of economic value. Racing activities strengthen technological credibility. Licensing and commercial partnerships extend the brand beyond automobiles. Genuine accessories, after-sales services, and especially vehicle personalization create additional revenue opportunities while reinforcing customer relationships. The annual reports also show another recurring theme. Ferrari regularly highlights product mix and personalization as major contributors to financial performance. Customers are not simply purchasing a standard vehicle. Many choose highly customized specifications, unique finishes, exclusive materials, and bespoke configurations that significantly increase the value of each order. This changes the economics of growth. Instead of relying primarily on additional customers, Ferrari can generate more revenue from existing demand. Instead of producing substantially more vehicles, it can increase the economic value embedded in each vehicle that leaves the factory. However, personalization alone still does not fully explain Ferrari's exceptional profitability. Many luxury brands also offer extensive customization programs. Many premium manufacturers also possess strong heritage and global recognition. Yet very few consistently maintain waiting lists, protect pricing power across market cycles, and continue treating production limits as a strategic advantage rather than a temporary constraint. That suggests Ferrari is managing something more fundamental than manufacturing capacity. The company appears to be managing the relationship between supply-demand and perceived value with unusual discipline. Understanding that relationship is the key to explaining why Ferrari's business continues to become more profitable, without following the industry's traditional path of producing and selling as many cars as possible. The turning point appears when Ferrari stops treating each vehicle as the primary unit of growth and begins optimizing something entirely different. This becomes visible in the company's financial results. During several reporting periods, Ferrari delivered roughly the same number of cars as before, or even slightly fewer, while revenue and operating profit continued to increase. In its official financial releases, Ferrari repeatedly attributed these improvements not simply to higher prices, but to a combination of richer product mix, stronger market allocation, and higher levels of personalization. Those three elements work together in a way that is easy to overlook. Start with supply. Because Ferrari does not flood the market with inventory, the company rarely faces the same pressure as mass manufacturers to discount unsold vehicles. Dealers are not competing to clear excessive stock. Instead of using incentives to stimulate demand, Ferrari protects pricing discipline from the beginning. That creates the first layer of value. The second layer comes from product mix. Not every Ferrari contributes equally to the business. Limited production models, special series vehicles, and higher specification products generate substantially greater economic value than simply increasing the number of standard cars leaving the factory. Rather than asking how many vehicles can be produced, Ferrari carefully manages which vehicles should be produced. The composition of production becomes just as important as production itself. Then comes personalization. For many customers, purchasing a Ferrari is only the starting point. Paint colors developed specifically for individual clients, tailor-made interiors, carbon fiber components, exclusive materials, and countless bespoke details transform one purchase into a much larger transaction. Ferrari has consistently identified personalization as one of the major drivers behind revenue growth. Every additional customization increases the value of a vehicle without requiring another production slot, another dealership, or another customer. That changes the mathematics of profitability. Instead of doubling production to double revenue, Ferrari can increase the economic value generated by each existing production slot. The company's recent financial performance illustrates exactly that principle. In the first quarter of 2025, vehicle shipments declined slightly compared with the previous year. Yet revenue still increased, and adjusted operating profit also improved. Ferrari explicitly pointed to favorable product mix, stronger personalization, and commercial activities as key contributors to those results. That is a remarkable outcome for any manufacturer. Normally, fewer units shipped would immediately translate into weaker financial performance. Ferrari demonstrates that this relationship is not always fixed. More importantly, each element reinforces the next. Limited production strengthens demand. Strong demand protects pricing. Stable pricing encourages customers to invest further in customization. Higher value per vehicle generates stronger margins. Those margins allow Ferrari to continue investing in engineering, racing technology, product development, and customer experience without relying on mass production. Instead of creating a cycle driven by volume, Ferrari creates a cycle driven by value. At this point, the company's strategy begins to look less like an exception within the automobile industry and more like a carefully engineered economic system. Yet one important question remains unanswered. If personalization, premium products, and disciplined pricing are all contributing to Ferrari's financial success, why have so few competitors been able to reproduce the same results? The answer may have less to do with the cars themselves than with the nature of what Ferrari is actually offering every time one of those cars leaves the factory. The answer begins to emerge once we stop looking at a Ferrari as simply a luxury automobile. A car is a physical product, but the value Ferrari creates extends far beyond the physical product itself. That difference explains why competitors can replicate horsepower, acceleration technology, and even craftsmanship, yet still struggle to reproduce Ferrari's economics. Consider what happens when Ferrari limits production. At first glance, fewer vehicles appear to mean fewer sales opportunities. Under conventional manufacturing logic, that looks like a sacrifice. But inside Ferrari's system, limited production changes the meaning of ownership. A Ferrari is not only difficult to afford, it is intentionally difficult to obtain. The company has repeatedly emphasized that preserving exclusivity is one of its central strategic priorities. During its Capital Markets Day presentation, Ferrari reaffirmed its long-standing philosophy of maintaining demand above supply, protecting the rarity that defines the brand rather than maximizing production whenever additional demand exists. That philosophy changes customer behavior. When availability becomes part of the product, purchasing a Ferrari is no longer evaluated only by horsepower design or engineering. Buyers are also responding to the knowledge that ownership itself remains uncommon. Scarcity, however, is only one part of the equation. Artificial scarcity without genuine value eventually fails. Luxury history provides many examples of expensive products that disappeared because customers no longer believed they deserved their exclusivity. Ferrari avoids that trap because scarcity is constantly reinforced by substance. Its racing heritage remains active rather than historical. Its engineering continues to evolve. Its vehicles consistently receive significant investment in performance design and technology. Its personalization programs allow owners to create products that are genuinely individual. Its community extends beyond the purchase itself through events, racing experiences, and long-term relationships with the brand. Together, these elements transform ownership into something larger than a transaction. The vehicle becomes an entry point into a carefully managed ecosystem. That also explains another decision that initially appears irrational. Why does Ferrari resist expanding production even when waiting lists remain long? Because every additional vehicle creates two opposite effects at the same time. It generates immediate revenue, but it also slightly reduces the rarity that supports pricing power across the entire business. When viewed this way, production volume is no longer just an operational metric. It becomes a strategic asset that must be managed with the same discipline as engineering quality or financial capital. Selling every possible car today could weaken the very conditions that make future customers willing to pay a premium tomorrow. That is why Ferrari's restraint is not evidence of limited manufacturing capability. It is evidence of strategic choice. The company is carefully balancing short-term revenue against the long-term value of exclusivity. Seen from this perspective, Ferrari is doing something that most automobile manufacturers cannot easily imitate. It is not merely selling transportation. It is not merely selling performance. And it is not relying only on premium pricing. The company is allocating access to an ownership experience whose value depends on remaining genuinely limited. Once that logic becomes clear, Ferrari's financial results no longer appear contradictory. Higher margins, disciplined production, extensive personalization, and sustained customer demand are not separate strategies. They are interconnected outcomes of a business model designed to protect the value of ownership before it protects the volume of sales. That distinction changes the way Ferrari's entire business can be understood, and it leads directly to the principle that explains why selling fewer cars can become a source of greater economic value rather than a constraint on growth. At first, Ferrari's strategy appears to contradict one of the oldest rules in manufacturing. Produce more, sell more, earn more. But every piece of evidence points in a different direction. Ferrari has consistently demonstrated that financial performance does not depend only on how many cars leave the factory. Product mix influences profitability. Personalization increases the value of every order. Strict pricing discipline protects margins. Carefully controlled supply prevents the erosion of exclusivity. Together, these decisions allow revenue and operating profit to grow without requiring production to expand at the same pace. What initially looked like separate business decisions now reveal themselves as parts of a single economic system. Limiting production protects scarcity. Scarcity strengthens demand. Strong demand reinforces pricing power. Pricing power encourages deeper personalization. Higher value per vehicle creates stronger profitability. Those profits fund better engineering, stronger racing activities, richer customer experiences, and continuous product development. Those investments, in turn, strengthen the desirability of owning a Ferrari, making disciplined production even more valuable. The cycle reinforces itself. This is why Ferrari's success cannot be reduced to expensive cars. If price alone created exceptional profitability, every luxury manufacturer could simply raise prices and achieve the same outcome. If scarcity alone created value, any company could manufacture fewer products and become more successful. Neither assumption matches reality. Ferrari succeeds because scarcity is supported by genuine engineering excellence, decades of motorsport heritage, disciplined brand management, and a customer experience that extends well beyond the moment a vehicle is delivered. The automobile remains the product, but the business is built around preserving the value attached to owning that product. Seen from this perspective, Ferrari is not optimizing for the largest possible number of sales. It is optimizing for the greatest possible economic value generated by each customer relationship. Every production slot becomes more valuable. Every delivery becomes more meaningful. Every customer contributes more to the business without requiring the company to continuously chase higher volume. That also explains why Ferrari has remained remarkably disciplined even when demand could justify significantly higher production. Increasing output might improve short-term revenue, but if doing so weakens exclusivity, reduces pricing power, or diminishes the perceived value of ownership, the long-term economics become less attractive. For Ferrari, protecting value is ultimately more important than maximizing volume. Perhaps that is the most interesting part of the entire story. Many companies measure growth by asking how to attract more customers. Ferrari begins with a different question. How can each customer create more value without reducing the value experienced by every other customer? That subtle shift changes everything. The company is not simply selling fewer cars at higher prices. It has built a business where the quality of each transaction matters more than the quantity of transactions. In an industry defined by economies of scale, Ferrari demonstrates that another path is possible. When a company can protect scarcity, strengthen desire, and continuously increase the value delivered through every purchase, growth no longer depends on selling more products. It depends on creating more value every time a product changes hands. That is why Ferrari's greatest competitive advantage may never have been the number of cars it produces. It is the discipline to ensure that every additional car must create more value than it destroys.